People who don't understand high dividend yield stocks just dismiss them by labeling them as yield traps. But that couldn't be further from the truth. Because what if I told you some of the highest yielding stocks in the market have outperformed nearly everybody? It's true. We're going to go over that. So in today's video, I'm going to be presenting my case and the argument for business development companies by answering the question, are BDCs yield traps? Without further ado, let's go ahead and get into it. But before we go anywhere, I think we should lay down and define what a dividend yield trap is. As you can see on your screen right now, yield traps are easily recognized by three things. Number one, a very high dividend yield, like 8%, 10%, or 12%, coming out of a normal publicly traded company, not in the realm of REITs, okay? And then number two, a share price that's really freaking cheap because they're absolutely beaten up. And then number three, struggling business operations. By investing into a yield trap, you essentially lose money because of the illusion of the high dividend yield, hence a yield trap. And to be absolutely transparent with you, when I started investing into the stock market about 7.5 to 8 years ago, I was absolutely drawn to these yield traps because I didn't understand that by investing into a stock, you're essentially becoming a part owner of that business operation, which means you really want to make sure that their fundamentals, financials, and metrics are all solid. I didn't care about that. All I saw was a very high dividend yield, and then I was like, okay, sign me up. However, with time and maturity in the stock market, I learned that's not the way to go. So, having said that, let's go ahead and go over some examples of a yield trap. First up is going to be Walgreens. They're in the business of retail pharmacy, which is an industry that has been absolutely disrupted by United Health, Amazon, CVS, and almost everybody else that does mail delivery services for your prescriptions. So Walgreens right now, they're currently trading for about $12 a share. Year to date, they're up by 28%. Oh, wow. However, if we zoom out and take a look at it from a bird's eye view, they're down by negative 71%, only taking into account their share price appreciation for the past 5 years. And then if we jump on over to their dividend profile, they don't pay a dividend. Amos, what's going on? Well, if you scroll down and take a look at their dividend history, the last time that they paid a dividend was November of 2024. So prior to 2025, Walgreens was considered one of those juicy dividend payers. But was it juicy as in high quality, or was it juicy as in like butthole sweat after running a 5K? It's smelly, disgusting, get the heck out of here. Well, it's the latter because they obviously cut their dividend. And leading up to Walgreens making the decision to cut their dividend, in the past 12 months, their dividend yield was about 9.5% until they made that decision to just get rid of it altogether because their business operations struggling. So a 9.5% dividend yield, ultimately, they pay nothing as of right now, a 0% dividend yield. And to be quite frank with you, after they made the executive decision to get rid of the dividend, I think their stock performance is pretty good. 28% year to date. By the way, right now I'm on finance charts. We're taking a look at the adjusted stock price total return. Takes into account the share price appreciation plus the dividends paid out, because I think if you don't bake in those dividends, it's not a holistic picture of the performance of an equity. Just my personal take. However, if we zoom out and take a look at the performance for the past 5 years, negative 62%. Even though they were paying those juicy high dividends with a dividend yield of 9.5%, you're still down by negative 62%. You knock and open the door because you see that very high dividend yield and you walk into a yield trap. You ultimately lose money by investing into a yield trap. Zoom out 10 years, your money would have shrank by negative 81.3%. And if we zoom out 20 years, then we're talking about negative 56%. If we scroll down and take a look at their CAGR, which is the compound annual growth rate, taking that total return number and breaking it down on an annualized level, for the past 20 years, your money would have shrank by 4% year over year. In comparison, SPY, which is an index fund for the S&P 500, your money would have grown by 10.6%. So I think Walgreens, I'm so sorry if you're invested into them. I think it's a textbook definition of what is a yield trap. But I'll give you one more. We're going to be talking about Kohl's, which used to be a huge competitor to JCPenney's, Macy's, Target. They're in the business of discretionary spending retail. It's a department store that you go into to buy a new jacket, new shoes. However, they did not make the commitment to do CapEx spending to jump into e-commerce. And now it's too late. I think they're way too late to the game. Walmart, Amazon, and Target are just eating them up. I don't think Kohl's has a viability to survive in the next 10 to 15 years. At least that's my personal take. So pretending that Kohl's is a car and we pop open the hood and take a look at the engine, let's take a look at some of their financials to figure out what's going on with this company. The first thing that we're going to be taking a look at is their top line, which is also known as the revenue. If the gross sales is not growing, then the company is ultimately shrinking, if that makes sense. So in 2016, they used to post $19.2 billion of revenue, which I think is pretty respectable. However, I think once the pandemic hit, that was like the nail in the coffin because their revenue dropped from $19.9 billion down to $15.9 billion. And they did make a rebound the following year in 2022 to $19.4 billion. But since then, as you can see, friends and family, it's just declining year over year. And right now, they still post $16 billion, which I think is respectable. However, seeing that they're not growing and that they're shrinking right here, year over year, shrinking by negative 6.8%, negative 3.4%. This to me, like, would you want to buy into a business to become a part owner of that company knowing that they're shrinking in their overall sales? It doesn't really give you a fuzzy feeling as an investor, right? Like, what's the investing thesis behind this company besides short squeeze, meme frenzy, speculative thoughts and narratives? When you look at the numbers and fundamentals, it doesn't really give me a fuzzy feeling. And when we take a look at the bottom line, this is also referred to as the earnings or the profits. In 2016, it was $670 million of profits going into their pockets after paying for everything. I think that's pretty respectable. And right now, in the trailing 12 months, also known as the past 1 year, now it's $121 million of profits. To see it be shrinking like that, immediate red flag alongside with the revenue. And it gets worse because if we jump on over to their balance sheet and we take a look at their cash and cash equivalents situation, the equivalence is basically money that's put into something that's really highly liquid, like a money market fund or high yield savings account, treasury bills. You get the picture. In 2016, they used to have $700 million of cash and cash equivalents. I would argue that's pretty good. And at the height of the pandemic, they were holding $2.2 billion. But if you take a look at what's going on in the past few years, look at that. Dude, that's so freaking bad. I think the transition from 2021 to 2022, it went down by 30%. And then the following year, it went down by negative 90%. And now they have $153 million of cash on hand. That's pretty bad. Any setback is enough to just make this company fall over and croak, unfortunately. And if we jump on over to their dividend profile, right now it's a 3.6% dividend yield, which I think is healthy and is sustainable as outlined by their payout ratio. 80% means from their earnings per share, their bottom line and profits, 80% of that will be utilized to fund the payout of 50 cents per share, if that makes sense, which means they have about 19% of their profits left over to do whatever they want to with that money. To reinvest into the business, to pay their workers a fair wage, and the list goes on and on. However, that wasn't always the case. It wasn't always a 3.6% dividend yield. Because if we jump on down and take a look at their dividend history, up until 2020, you can see that they were growing and increasing their dividend payout year over year. And it's every quarter. So every 90 days, that's how much they paid out. And then during the pandemic, they did their first cut. And then they jolted it right back up to 50 cents every quarter. And then they cut it again. And that's why I always say on this channel, you cannot disregard the company's timeline, DNA, and history. Because if they showed that in the past, if there's obstacles and setbacks that they cut the dividend, that means their operations suffered in a way that they were not able to sustain and pay out that dividend. Which means in the future, if there's any more pain or setbacks, they're gonna cut that dividend. You do it once, you're gonna do it again. As of right now, absolutely. Their dividend yield, nothing too crazy. At 3.6%, I would argue is pretty darn decent. However, if you take a look at their dividend yield in the past 1 year, trailing 12 months right there, it was a 9.9%, just shy of 10%. So by looking at a company that had a 10% dividend yield in Kohl's, and you were attracted to that and you invested into them while disregarding all of their financials, metrics, and fundamentals, dude, ultimately their dividend got cut and now it's a 3.6% and you're losing money in them. What do I mean by that? So year to date for Kohl's, taking into account their share price appreciation plus the dividends paid out, a 0.8%. If we zoom out 1 year, we're talking about negative 24.5%. If we zoom out 5 years, negative 21.6%. Can you imagine investing into something to become a part owner of that business? And then after 5 years, what you have to show forward is that your money shrank by negative 21.6%. Friends and family, textbook example of what a yield trap is. If we zoom out 15 years, negative 40.9%. Hopefully 20 years will look better. Do you think it will? Let's see. Negative 51% in 20 years as your total return performance. Pretty darn bad. If we scroll on down to take a look at their CAGR, how that plays out, for the past 20 years, annualized year over year, negative 3.5%, your money would have shrank. Pretty darn bad. In the exact same time period, S&P 500, 10.7%. Friends and family, Kohl's, Walgreens are yield traps, which is why I understand on a surface level why some investors just dismiss companies that pay a dividend yield of like 9 or 10% as yield traps for everybody that in that category. But guys, once again, I am telling you, there are stocks where their dividend yield of 10% is by design. Like that's the way it should be for that publicly traded stock, which brings us to BDCs. Business development companies, aka BDCs, are investment firms that lend money to other businesses that otherwise can't get funding from Wall Street or other big banks. For example, these businesses include car washes, restaurants, or startups. And the catch is, by law, they have to pay out 90% of their profits out as dividends. Sometimes they do pay a little bit more, like 92 or 95%, but at a minimum, they have to pay out at least 90% of their bottom line out as dividends, which means by design, massive dividends. Now, I made plenty of videos that review how to assess and analyze BDCs, but also there's videos where I break down the entire industry, because when you only look at one company by itself, you might think that it's a hidden gem or that it's beautiful or that it's a dividend compounder. But when you put it into the context of the entire industry and put it up against all of their peers, then you can truly see who's spectacular and who's ugly. You have to read in context. When I used to be a seminary student, we learned about hermeneutics, which means you can't just take something out of context. You got to look at stocks in comparison to their peers. Now, you should go and watch those videos to get up to speed, because right now, in contrast to these yield traps of Kohl's and Walgreens, we're going to be taking a look at some of the more popular BDCs that pay a crazy high dividend yield. And the first of the bunch is going to be Ares Capital Corporation, ticker symbol ARC. We're going to be taking a look at their financials right here, income statement, their revenue. Take a look at the growth of their top line. In 2015, it was $1 billion, which I think is pretty respectable. To generate $1 billion of gross sales in a single calendar year, doesn't matter what line of business you are in, sector or industry, that's pretty darn impressive. And look at how it's been compounding throughout the ages. Obviously, 2020 was a fluke year, but other than that, consistently and reliably been growing their top line. It's a pretty beautiful picture to see. Really. And then if we jump on over to their return on equity, which basically shows us how much net income, aka profit, that they generate relative to their shareholder equity, this is a really good ratio to use when evaluating a BDC. As of right now, it's a 10.2%, which I would argue is pretty darn good. And if we jump on over to their dividend profile, because it's a proxy for their business growth, since 90% of their profits are paid out as dividends, right now it's an 8.5%. Some people, not understanding BDCs, will immediately dismiss them, saying, dude, that's a yield trap right off the bat. Because they're going to be like, oh, the payout ratio is 94%. Why is it so high? It's high by design. Because if we take a look at their dividend history, take a look at this. They pay a dividend every quarter, by the way, not every month, not every week. I know right now there's investment vehicles out there that pay a ridiculous dividend yield every week. Sooner or later, we're going to have a dividend stock that pays every single day. I don't know if we're going to get to that point, but ARK is every 90 days. In 2015, they used to pay out 38 cents every quarter, which means they were paying out 90% of their profits. That translated to 38 cents every 90 days. And as we fast forward throughout the years, exactly what you want to see. It's growing up and to the right, and now it's 48 cents. And how does this portray itself as a total return in their performance in the stock market? So right now, they're currently trading for about $22 a share with a high dividend yield, right? Past 1 year, their performance is 18.2%, which I think is pretty respectable. If we zoom out 5 years, we're talking about 150%, just shy of. Please don't be that wise guy, okay? 150%. If we zoom out 10 years, we're talking about 261% for a company, a BDC, that has a ridiculously high dividend yield. So by definition, they cannot be a yield trap, because with a yield trap dividend stock, you essentially lose money by investing into them. That high dividend yield doesn't matter because it's eventually going to get cut. But with ARK, your money would have grown. Check this out. If we zoom out 20 years, 900%. 900 freaking percent with ARK. Essentially, your money would have 10x'd in 20 years by investing into a BDC. And if we compare it to the S&P 500 and we scroll down right here, for the past 20 years, their CAGR, 12.2%. In the exact same time period, friends and family, the S&P 500 was 10.7%, as you can see right there. So this high dividend yield paying stock, a BDC, outperformed the market for the past 20 years. So you tell me, does that sound like a yield trap? Absolutely not. And if we take a look at their dividend yield for the past 20 years, on average, it's usually around a 9.2%. Right now, it's an 8.5%. So their dividend yield fluctuates. It goes as low as 8.5% and sometimes as high as 10%, but on average 9.2%. So that means right now their share price is high, which means it artificially decreased their dividend yield. So it's not a bad thing. It's just what's happening. And we can do this exercise again with another BDC known as Main Street Capital, ticker symbol MAIN. Now this one is a little different, because usually with a BDC, their share price usually remains flat and it grows at a very small rate. However, the dividends are consistent and reliable. But with Main Street Capital, their share price, it behaves and acts like a growth stock. So the share price grows like a rocket, but also the dividends paid out are also freaking high as well. So this one has the best of both worlds. So if you're under the age of 60 and you're still working, Main Street Capital might be a good option to look into. That's not financial advice, but check this out. Let the data speak for itself, okay? Past 1 year, total return is 44.7%. I would argue, if your money grows by 44% in 365 days, are you going to tell me that you're going to be upset? And no, we're not talking about a semiconductor or an AI tech stock. This is an investment firm that lends money out to other businesses, and they're generating a 44% performance in the stock market. I think that's pretty respectable. If we zoom out to 10 years, we're cooking with 380%. My goodness gracious. If we zoom out 20 years, 1,800% Friends and family, I'm going to repeat myself in case you're not paying attention. 1,800% total return by investing into a BDC known as Main Street Capital with a very high dividend yield. No, it is not a yield trap. And what makes this even crazier is that they debuted on the stock market on October 2007. So they don't even have 20 years of history and they're still posting 1,800%. That's pretty wild. So I think we should zoom back into 15 years, 1,270%. Keeping that number in mind, if we break that down on a year-over-year basis, their CAGR for the past 15 years is 18.8%. Exact same time period, the S&P 500 is 14.3%. My goodness. And historically, when we take a look at Main Street Capital's dividend yield for the past 15 years, it's usually around a 6.2%. Right now, it's a 4.5%, which means their share price appreciation is outpacing that of their dividend growth, which is not a bad thing because your portfolio's valuation is still growing. So I think it's a good thing ultimately for me. For other people, they might disagree. They might want to see the dividend yield be bigger, which means their share price is eroding. That's a whole different conversation of its own. But I would argue that's not an effective way to see whether or not they're paying more dividends by just the yield. I think a more accurate way is to assess by their dividends paid out. And we can do that right now. So if we go to Main Street Capital right here and jump on over to the dividend profile and we scroll down right here, as you can see by their dividend history, it is growing consistently up into the right, and their payout frequency is every single month. So just like Realty Income Corporation, Main Street Capital is beautiful. So as you can see by these spikes right here, not only do you get a dividend every month, sometimes they give you an additional dividend on top of that one. So like right here in 2017, you got one in December 18th and you got another one a couple weeks later in December 28th. And the pattern repeats itself again and again. And sometimes when they can't crush it as hard, they still give you an additional dividend on top of that monthly dividend payout. So Main Street Capital, I think there's a lot to like here, but if we just assess them by their monthly dividend payout, 18 cents in 2015, and right now it's 25 cents every 30 days, which I would argue is pretty darn respectable. So I think that's a more accurate way to depict whether or not the dividends are increasing rather than just by looking at the dividend yield, because the dividend yield is essentially the dividends paid out divided by the share price. And I hear you. You might be like, dude, you're cherry picking. Show us more examples. And we'll do that right now. The next one is going to be Capital Southwest. They're also a BDC. And if we take a look at their performance in the past 1 year, 5.3%. Yes, objectively, that's nothing to write home about. You could have probably gotten a better return by investing into a money market fund and investing into yourself by taking classes at the local community college. A 5% total return. Come on. But friends and family, you can't just look at it and cherry pick just one timeline of 1 year. You got to look at it holistically. Remember what we talked about earlier? If we zoom out 10 years, we're working with 227%. If we zoom out even further and we do 20 years, check this out, 1,900%. And unlike Main Street Capital, Capital Southwest, they do in fact have 20 years of company history on the stock market. So 1,900% total return in 20 years. I don't know about you, but I would be pretty darn happy getting those kind of returns in my portfolio from Capital Southwest. If we break that down, 16.2% year over year for a company that pays a freaking high dividend. Are they a yield trap? I'm asking this question once again because there's so many freaking people in the investing community, especially dividend investors, that hate on BDCs without understanding the facts. Like, how can you argue with the facts here that your money is growing like this year over year unless you just hate making money? I don't know. And as of right now, if we pull up their profile, their dividend yield is 11.3%, and they also pay it out every 30 days, just like Main Street Capital. Pretty phenomenal. If we take a look at their dividend yield on a historical basis for the past 20 years, dude, I'm not a robot. Why are you verifying? Okay, we're good to go. If we scroll on down and take a look at their dividend yield, in the past 20 years, on average, it's usually a 7.3%, which means in the recent times, their share price has been crushed, which artificially boosted the dividend yield. That almost makes me want to investigate further to see what's going on and if it's a good time to buy into Capital Southwest. So that's probably what I'm going to do after making this video. And if we jump on over to another example of a BDC, Is it a yield trap? We're going to be taking a look at Blue Owl Capital Corporation, ticker symbol OBDC. Right now, their dividend yield is 11.3%, and they're currently trading for about 14 bucks. On surface level, there's a lot of red flags. Why is their dividend yield so high? Why is their share price so low? Why are you ranting and going on and on about this yield trap? I hear you guys. However, let's do this once again. If we take a look at Blue Owl Capital Corporation's performance in the stock market for the past 1 year, a 9.3%. Which I would argue is respectable with a capital R. Nothing to write home about. It's not enough to go change your MySpace status and be like, guys, I got a 9%. It's nothing to like brag about, but it's still decent, right? A 9% yield in 1 year. And if we zoom out to the past 5 years, unfortunately with Blue Owl, we can't go past 2019 with them. So if we just look at the past 5 years, then we're talking about a 99% total return, just shy of 100%. If we break that down on an annualized level, in the past 5 years, the CAGR is 14.4%. And finally, we have a BDC that underperformed the benchmark, the market, the S&P 500, 15.4% in the exact same time period. However, are you really going to complain and be pissy and angry about a 14.4% CAGR? Which begs the ultimate question, and circling back to the intro, are BDCs yield traps? Or are they misunderstood income machines, as we just learned? Because even if they underperformed the S&P 500 as a benchmark, they're still yielding a great CAGR, a great performance and a total return. So between you and me, I think BDCs are easily one of the most underrated income plays out there, especially if you're walking towards retirement or if you just want that passive income to be pouring in every 30 days or every 90 days. BDCs, I get it. They're not for everyone, but to dismiss them and label them as yield traps, to be honest with you, that's ignorant. You can't really do that if you are growing your money through them, as we just learned from the data. You can't argue with the numbers. So I'm going to go on record by saying it right now. BDCs are absolutely underrated in the dividend investing community. I think they deserve more attention. Kind of like Dennis Rodman for the Chicago Bulls. I think all of the spotlight was around Scottie Pippen and Michael Jordan. But dude, Dennis Rodman was easily doing all of the dirty work, defensive playmaking that led to the dynasty run that the Chicago Bulls had. But anyways, that's just my thoughts and opinions. What do you think about BDCs? I like them. And I get it. Right now, the hottest fad and trend, everybody is talking about yield max ETFs and Roundhill and Neos and all these other weekly dividend paying investment options. I get it. But BDCs and REITs, dude, I think people are sleeping on them. I like to invest into the tried and true. So there you have it. We answered the question. Are BDCs, business development companies, yield traps? Absolutely not. Now, I'll caveat that by saying maybe the low quality ones, the ugly and the messy BDCs, they might be yield traps. But the ones that we talked about here today, the popular ones, I think they're pretty good. And other than that, before I sign out of here, it was a pretty good sports weekend. My Seattle Seahawks won their preseason game against the Chiefs. Yes, I watched the entire thing, and dude, the Seahawks' future looks pretty promising. Some people were bagging on the Sam Darnold signing, but to me, I think he's going to have another 4,000-yard passing season. That's just my hot take. Is it going to pan out? I don't know. But as you can see by the flag in the background, huge Seahawks fan. And then Tottenham. Dude, we ripped apart Burnley 3-0. I'm going to tell you this right now. Mohamed Kudus, easily one of the best signings in the past 3 years in our history. As you can see, I'm wearing the jersey. So to have our first victory, a W in the column for the Premier League table, I'm pretty happy. Yes, Burnley just got promoted from the championship and they're not really a Premier League side, but still, to win 3-0, whereas last year we finished number 17th on the table, just let me have my victories, okay? And prior to filming this video, I actually just watched Sunderland and LAFC beat the New England Revolution. pretty good stuff, in a pretty good mood. And after editing this video, I'll work on the earnings recap and earnings highlights for this upcoming week. That video is also going to be posted. Anyways, I appreciate you guys. Thank you for watching. Thank you for the engagement, meaning clicking like and leaving comments. I don't even beg for that anymore. You guys just do it on your own, which I truly appreciate. So stay safe, good luck in the stock market, and I'll talk to you really soon. Like really soon. Peace.